Let's now ask New York Life's Lauren Goodwin. She joins us now. Lauren, record highs for the S&P and NASDAQ. It's like a broken record at this point. Did anybody, including yourself, really expect that we were going to see this constant ratcheting up? Not massively so, but a slow melt up of record highs throughout the course of 2025.
I don't think so, especially not after Liberation Day. And my estimation is that we are likely to see market jitters associated with all the policy change that we've been getting. And that policy change is starting to make its way into the economic data, in inflation data, in jobs data, et cetera. But at this point, my expectation is that we might not really see the worst of those impacts until next year. And so we're looking at a rally that's pretty healthy through the end of the year.
So a record that's healthy because in many ways there is an expectation for those interest rate moves. Are those interest rate moves necessary in your mind, given the economic backdrop we've gotten? It's muddied at best at this point. There's so much conflicting data out there. But is that rate cut path something that the market needs to hold on to?
I think that this first cut has become necessary for that market confidence. And the reason for that is a little bit the weakness in the labor market that we've seen and some, let's call it insurance, let's say, to get ahead of an otherwise pretty healthy economic cycle. But we're not convinced that this rate cut that we do believe we'll see 25 basis points on Wednesday is the beginning of a consistent interest rate cutting cycle from here. I think we are likely to see rate cuts ahead, but one every meeting. We think the market's getting a little bit ahead of itself based on the data that we're seeing out there. That's not only the risks to inflation, but also, as you mentioned, financial conditions are so loose. Equity prices are high. Bond valuations are high. The availability of credit is quite healthy. That's a pretty constructive market backdrop.
We've heard a lot of folks talk about this idea of where the focus lies with the Fed right now. The dual mandate is employment. It is inflation. Which one comes first? It seems like it's tilted more towards the employment job side of things, less so on inflation. But amidst all of that, is the backdrop good for an interest rate cut at this point?
Yeah, so I completely agree that the Fed's focus has shifted towards the labor market over inflation. And Chair Powell was pretty clear about that in his Jackson Hole speech. He said that our base case, though there are reasonable risks outside of it, is that the increases in prices we're seeing are likely to pass over time. That expectation, though, that balance of mandates can absolutely shift. And I think it would be hard for the market to continue pricing in 75 basis points of cutting this year, another 75 next year, if we start to see another 0.4%, 0.5%, 0.6% month-on-month inflation figures, which I do think could be coming down the pike. And so, please.
No, so if you have that scenario, there are parts of the market that have been maybe off limits to certain investors given certain concerns about valuations vis-a-vis rates, other parts of the market that have been called values. So where exactly then does that tilt you as an investor towards what you should be looking at for the next 6 months?
So here's the really challenging thing. Valuations are high across asset classes, but the things that are expensive in many cases are expensive for a reason. And those are the things that I think are most likely to actually benefit from this cut in interest rates. Typically, in an interest rate cutting cycle, or if the economy is reaccelerating, and there are some signs that that could be the case moving forward, you would expect to see a real broadening in activity, small caps to outperform, for example. In this case, a lot of the run-up in valuations that we've seen is not just about the economic cycle, but also about structural improvements and ideas related to things like artificial intelligence. We also have seen credit spreads tighten and tighten and tighten, not only because the economy has held up, but also because of Fed programs that ensured good corporate cash balances. In an environment where 25 basis points are coming off the top, the only thing that really changes for those areas of the market is that you might see more money from the money market funds moving into bond markets. You could actually see valuations move even higher as a result of this Fed move.